Welcome to the BRRRR Cashflow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
Hey, what's up, everyone? Welcome to another exciting episode of the BRRRR Cashflow podcast. Now, last week marked our 6th episode of the Buying Your First Rental Property series, Due Diligence. Now, on this final episode, I'm going to assume that you have successfully closed and purchased your first rental property, and now we're going to be talking about managing and scaling your rental portfolio. Because I've been to a lot of meetups, conferences, I've met investors through the Bigger Pockets forums, and I have seldom met an investor who only does one deal and calls it quits or is done. The goal is to find a formula that really works for you and your goals and really repeat the process enough times to achieve the target passive income or financial freedom number. So the question becomes, how does an investor scale from a single rental property to a handful of properties or even tens or hundreds of units, if that is your goal? So I'm going to talk about different ways that you can scale your rental portfolio, and also managing it is going to be a crucial part of your real estate investor journey. Now, before we dive into the scaling piece, I want to first talk about managing your portfolio. So if you've listened to the previous episodes, my assumption is that you're a real estate investor buying out of state, because I personally am living in California, where it is really expensive and difficult to cash flow on some of these properties because of the rent to value ratio, or maybe the landlord tenant laws are not in my favor. So I do go to the Midwest to buy these properties, and some of the questions that I typically get is, what do I do? On my day-to-day jobs, it's managing my managers, whether it be my contractors, brokers, agents, as well as property managers. I check in on them daily, if not at least weekly, to see how the lease-up process is going, if I have any problems with any tenants in terms of collectability. If I have various work orders, I want to check in on the status. I want to ask for their advice on, hey, should I go with option A or option B? What kind of flooring should I put in? Based on the number of deals that I have done, I have a pretty good sense of how I want to rehab and apply those finishes to my rentals. But other cases, I might reach out to my property managers, or if I'm doing a flip, I might reach out to the broker and agent in the area and get their opinion on what type of finishes would really make sense for this neighborhood, for the end buyer that I'm trying to attract. If I am actively pursuing an acquisition, I'll probably spend the most time. I'll spend anywhere from 5 to 10 hours from end to end when I first find the deal and underwrite it, make an offer, negotiate, do the inspection, work with my lender to finance the deal, and then close it. Probably spend about 5 to 10 hours collectively. And then once it's under my control, then I'll go ahead and send over my contractor to start the rehab. They've already been there as part of the due diligence process. I already have a scope of work. So as soon as I close, they're going to go in there and start the rehab process. Now, rehabs will take anywhere from 2 weeks if it's just very cosmetic, just paint and flooring. If I'm, taking down walls, moving walls, if I'm doing a new kitchen, bath, things like that, it might take a little bit longer. Probably the longest project I've ever done is probably 2.5 months, and that includes a 10-unit apartment. But for these properties, I'll go ahead and check in with my contractor at least once a week. I ask for a video. I like to do FaceTimes if possible, ask for lots of pictures, and then I'll also send somebody like a local investor, property manager, or broker to also go check it out and verify what they're telling me. And then I also sometimes use commercial or hard money lenders, and they require me to send a third-party inspector to verify when I'm asking for those draws to pay my contractors. There is a float period. So from the time that I pay my contractor to when I get reimbursed from my lender, There might be a 1 to 2 week lag. And during that period, the lender is going to send a third-party inspector. And this gives me additional comfort. It's probably like $100 each time to do this. But it gives me additional comfort that the lender is comfortable. I've already checked it with my boots on the ground. So there's at least 3 or 4 people verifying the quality of the work. So that's how I probably spend most of my time on the acquisition rehab piece. And then once we are complete, I pass it over to my property manager. At that point, it's pretty easy. I'll probably check in on them once a month if needed on any properties. I'll probably spend 1 to 2 hours a property just doing the books. Bookkeeping is going to be a crucial part. Whether you just use a spreadsheet, that's just the way that you like to document. I personally recommend using QuickBooks Online or Stessa or some sort of software, because there's going to be lots of features and functionality that you like, whether it be a dashboard or reporting perspective. That's going to help you if you set it up right from the get-go. So you might be thinking, oh, a spreadsheet might be totally fine. I don't need QuickBooks. It's like $20 a month. What do I need that for? But as you quickly move from one rental to maybe a couple to 10, then you're going to realize that it's going to be a pain if you have to customize your spreadsheets a certain way to get the reporting that you want. The requirements might be different. If you start to use commercial lending, they might want a quarterly financial statement from you. So things like that, it's good to always think ahead and kind of build it out to where the puck is going instead of, okay, just skating to where the puck is, right? So on that note, maintaining records, again, probably take me about an hour or two per property a month. So it shouldn't take you that long. It might be even less. Right now I'm using Stessa, which I think is a great software. I'm not sponsoring them. They're not a sponsor of this podcast, but I personally just love using them. So I do recommend it. I have all 61 of my units in there. I also track my corporate expenses, whether I go out for meals with my partners or my wife when we talk about real estate all the time. I'm going to put that on the company card and expense it. I track it that way. Any mileage, anything to do with travel for my real estate business, things like that, I'm going to all track it in Stessa, and I think it does a great job. Come tax time, there is, with a click of a button, you can export all your financial statements, your capital expenditures, things like that your CPA is going to need to file your taxes, issue the K1s to your partners, things of that nature. It's really easy to do with a software, so that's why I really recommend it. And best of all, Stessa is free. So if you're trying to save some money, you don't want to pay for the QuickBooks Online, then I would recommend at least use something like Stessa. You also want to think about your expenses as you go along, right? So you're going to start off with the underwriting process. Like I mentioned on the previous episode, you have some assumptions. How much your expenses are going to go up, your taxes and insurance. Now, if you've had the property for a year or two, chances are right after you bought it, depending on your local taxes and municipalities, your taxes may have gotten reassessed because it transferred hands, transferred title to a new owner. Maybe you're going to lose some of the deductions that a homeowner local in Indianapolis may be getting. Now you're 2,000 miles away in California, your taxes might go up. So it's always nice to revisit and take a look at how your expenses line up in actuals versus what you have budgeted or have underwritten in your pro forma. And you have to understand those numbers, because if you it's not a set it and forget it, right? As much as people say it's passive income, you do have to manage your managers and you do have to keep an eye on your portfolio financials. It's very important that you know that, so that, okay, when it comes to decision time where you have to raise the rents or you have to understand negotiating insurance rates, things like that, do I have to find another insurance broker? Maybe across your 61 units, you realized your insurance broker has upped the charge and it's gone up by $50 a door. But maybe if you take all of those units and you take it to another provider, they're willing to give you at least 10% off. Then that's going to be a sound financial decision, assuming all other things are equal in terms of coverage and the service and things like that. So it's definitely something to keep an eye on. And then also, as you grow your portfolio, I'm not going to go too deep into this, but asset protection is very important. So whether it be umbrella insurance or you get LLCs or C Corps, S Corps, different types of corporations to kind of really help separate you, the personal finance person, versus the corporation or your rental side of the business, it's going to be very important to understand what your options are. Talk to a CPA, talk to an attorney to see what really makes sense for you. Because we've actually had this discussion recently in our mastermind, is that when you're starting out, you're buying one property, probably it's worth like $100,000 in the Midwest, and you're putting 20% down. So it's an 80% loan to value, or 80% is owned by the bank. At that point, you don't have much to lose. I mean, worst case, you're going to lose $20,000 because they can't take what's not yours, right? Which is that $80,000 that the bank is owned. In the beginning, it might not make sense for you to pay all this in umbrella insurance and get different types of LLCs. It just doesn't make sense. You have to have a separate bank account. A lot of administrative work goes into it. However, let's just say you go from a dozen to 2 dozen, you have a couple dozen rental units. At that point, you might have hundreds of $1,000s in equity, and that is something definitely worth protecting. So you really got to see what your risk appetite is and what the cost of doing that. It's just like insurance for your car, right? So you want to understand those types of liabilities. Make sure you talk to multiple attorneys because each attorney might give you different advice, and really talk to people who understand the subject, not just other investors who think they know the law, but really talk to subject matter experts and then make a decision that makes sense for you. All right, with that said, now I want to shift gears and talk about how you can scale your rental property. As mentioned earlier in the podcast, I have rarely seen an investor who only does one deal. So how do we go ahead and scale from one? Well, the first and most obvious answer is going to be spend less and investing the difference. So the tragedy that I really see with a lot of people who continue to make more and more income as the years go by, so they get a promotion, they get a pay raise, they get bonuses. There's something called lifestyle inflation, and unfortunately we're all guilty of it. I'm guilty of it. I mean, I just recently bought my wife a Tesla. We're also moving into a new house. And it just really happens. You get a taste of the finer things in life, so to say. You know, you want to take that trip to Hawaii. And you don't have to obviously feel too guilty about it if you are continuing to invest and spend less than what you are earning. So in this option, it's a no-brainer, but sometimes very easy to be overlooked. As a buy and hold investor, you are in it for the long haul, meaning that you have to be consistently earning more than you spend. I personally suggest that you get to a place where you are comfortably stashing away 30 to 40% of your earnings and invest the savings into cash flowing real estate, which is what I'm doing, and repeat the process. So each time you go through the cycle, you should have additional funds from your new rental property to help enhance the velocity of this cycle. Again, the mistake that I see investors make is that they begin to inflate their lifestyle along with their newly built portfolio. So for example, they may have put $25,000 down to purchase a turnkey duplex in the Midwest, and it generates $400 a month in passive income. And this is great. So this is after all expenses and debt service. They're pocketing $400 a month, but they use this $400 a month to pay for a new car lease that they otherwise wouldn't have bought if they didn't have this cash flow. Now, ultimately, we do want our cash flow to pay for our expenses. And while rewarding yourself is important, I believe this is a risky move to do such at an early stage when you're building, because you're in the growth phase, remember. That $400 a month of cash flow is never 100% guaranteed. So depending on the vacancy, the maintenance work orders, COVID, God forbid, your tenant might not be paying and it could lead to an eviction. Other things can go wrong. So in my opinion, that $400 a month should be stashed away, and you should continuously build upon that pot, and it should be ready to invest. You shouldn't live off of that cash flow, especially when you're starting out and you're in the growth phase. So during this time when that $400 a month is not coming in, let alone you have to pay for the mortgage because there is no rents coming in, you are left paying the mortgage and the expenses related to the upkeep of the rental, in addition to the new lease payment for the car that you just bought. So you have effectively dug yourself into a bigger hole to climb out of, which is not a position that you want to put yourself in. If you're looking for insurance coverage for your rental properties, the company that I trust is Ross Diversified Insurance Services, a national insurance agency that has been providing insurance coverage for real estate investors for over 30 years. Whether it's a rental or a fix and flip, Ross provides you coverage through A-rated insurance carriers to provide you with competitive rates, as one size does not fit all. Check out biggercashflow.com/RDIS to get your free quote today. When you're purchasing your first property or the next, you want to work with an experienced lender who's got your best interest in mind. Sean Huss at Chemical Bank has been a professional in the mortgage industry for over 25 years and has helped hundreds of investors like you and me grow their rental portfolio. With expertise in areas such as real estate sales, title and escrow, and the mortgage closing process, Sean is able to provide comprehensive counsel to guide you throughout this often complicated process. Check out biggercashflow.com/chemicalbank to get pre-qualified for free when you mention the Bigger Cashflow podcast. So my advice is to continue living as if you have not created the additional stream of income. Think of it almost like a 401k or a IRA account, like a forced savings account that is restricted from use. And by placing this phantom restriction on the newly created income, you'll be able to reinvest the earnings into your business again and again, exponentially assisting the growth of your portfolio. So let's just say you were able to buy 2 rentals in a year through this process. By year 5, you have 10 properties that generate $4,000 a month in passive income, which means that every 6 months, the cash flow from your rental portfolio alone is enough to purchase another rental so you can buy 4 properties a year instead of 2. So it's kind of like the big brother is generating enough income to pay for the little brother, which is going to be that new rental portfolio. So this will shorten the growth of your portfolio from 5 to 2 years and so forth, because it's exponentially growing and you're not living off that income. This is otherwise known as the snowball effect that myself and a lot of investors have realized while building our portfolio. So I've personally increased my W-2 income over time. However, I have not inflated my lifestyle at that same rate. So I'm already having a spread. And then also I'm using that to invest in cash flowing real estate that I'm also not spending. And I'm continuously putting it back into the business. So over time, I see my net worth growing exponentially. So another method to scale is going to be using other people's money, otherwise known as private lenders, or using the BRRRR method. A private lender is an investor who makes loans secured by real estate and promissory note, typically charging higher rates than banks, but also making loans that banks would sometimes not make, like whether it be a rehab loan on a distressed property. And also they fund much more quickly than banks and require less documentation because they typically are financing the asset and not the person. They're not looking at your W-2, they're not looking at bankruptcy, things like that. As long as the property and the scope of work and the ARV really make sense, and they do typically look at your experience or at least require that you have a partner that has the experience, private lenders are a great way to secure financing and scale up that way. Private money exists because many real estate investors need a quick response and quick funding to secure a deal when looking for a real estate loan. So if you're purchasing from wholesalers typically or off-market deals where you're directly contacting the seller, they're not going to want to wait 30, 45 days to get their money. They want to get in and out in 7 to 14 days, just as an example. So banks and other institutions that offer the lowest interest rates, your typical Fannie and Freddie type loans, they're not going to provide the same combination of speed and transparency in their decision-making process. There is a lot of underwriting. They're going to ask for a lot of documentation, and you yourself need to be lendable. So by securing private lenders who will fund 80 to 90% of the purchase price and or rehab, you have significantly reduced the amount of capital you need to acquire a new deal. As long as you can find a deal that is all in near or below 70% of the ARV, basically a discounted distressed property, renovate it and force the appreciation, that will essentially take place of a normal cash down payment. So that is called the BRRRR method, where you are buying distressed property. Let's just say it's worth $100K, but you're buying it for $40,000, putting $20,000 into it. So you're all in at 60 cents on the dollar. Then instead of coming to the table with a 30% down payment, 20% down payment, your equity, your sweat equity of finding that discounted deal and putting in the rehab and holding that risk is going to replace that down payment. Now, there is a lot of risk. Don't get me wrong. Real estate investing in general is risky, but if you know what you're doing and you have criterias and execution in place, it is a great way to scale your portfolio without having to come up with that down payment, $25,000 each and every time. Because let's just say you even start off with $100,000, that's going to dry up really quickly. You buy 4 properties with 25% down, and now you have to wait for the next $25,000. Whereas if you use the BRRRR method, you are able to recycle that same cash because you are creating that value. Now, again, definitely go in with your eyes wide open. Don't just jump right in. Like I've mentioned in all of my other episodes, I have seen a ton of newbies who thought BRRRR is the best thing since sliced bread, and they just want to buy properties and start renovating it, not understanding the after repair value, or not understanding that they can go over budget, or maybe you make your money when you go in, so maybe they even bought it overpriced. Then you've really put yourself in a tough spot because you can't under rehab it, right? Because it's not going to appraise at the right value anymore, but you've effectively put yourself in a situation where you have to go over budget now. And now you're not going to be at that 70% of ARV. So you want to make sure that your numbers are really tight. That's why I recommend a lot of newbies to start with a turnkey property and then transition over to a BRRRR method later on once they have understand the real estate acquisition, rehab, and managing cycle. But don't do it from the get-go. It's just my 2 cents. Now, another strategy is going to be the HELOC, a home equity line of credit. So especially in a rising market where you have equity in your home, maybe you are in California and it appraises for $100,000 more than what you've bought it. It's kind of like a second mortgage where your home is served as the collateral, but a HELOC is a revolving line of credit, like a credit card with simple interest, but it's not amortized, right? So this means that you're able to withdraw money up to an approved limit using the bank transfer, card, or check, repay it, and draw it within the predefined terms of the loan. So typically, a lot of people might get a home equity line of credit to make some home renovations, repair, or use it for other types of needs. Definitely don't use it to go on a lavish vacation or buy a jet ski. Now, this strategy might not work for everybody, but it personally did for me, where I had about $50,000 available in the form of a HELOC. And I used that to pay for some renovations on my rental properties or use it as a down payment, where the interest rate was only 4% at the time. I understood the risk, but I also understood the upside of if I invest that money and put it into a cash flowing rental property in the Midwest, then I can see upwards of 15% in returns. So that's exactly what I did. I bought a distressed property. I needed about $20,000-$30,000 to rehab the place. So I bought it for $30,000 and I put about $20,000 into it, and it appraised for $85,000. So for me, I created a ton of value. I refinanced that property with a Fannie Mae lender, and I got about $65,000 back. So I got my initial investment and I got enough money to pay down my HELOC back to zero. So instead of going to a private lender at 8% or a hard money lender at 11-12%, I'm going to borrow it from myself. I'm the bank. And at only 5% or 4%, it's going to be a good source of quick and cheap capital compared to some of the other methods out there. Last but not least, another option that you can use to scale your rental portfolio is going to be strategic partnerships. And that might be in the form of a private lender, such as just a money partner. But now instead of giving them just a return on their money, you're also giving them some equity. So they also have skin in the game. Now, there's definitely pros and cons of doing this because partnerships, you're really, when I say equity partnerships, you're really attached at the hip. So if I had a private money lender that is just a debt, then whether the property goes up by $100,000 or it goes down, I just need to pay off the debt, right? Whether I refinance it or add that value. However, if you have an equity partner, let's just say you're 50-50 on a property, you're really on the same boat. You make decisions together. So you really have to make sure that partner has the same goals as you and make sure that you guys are going to be in alignment when you guys are making the decision, whether it be where you're going to buy, what type of properties, how you're going to manage it. Are you going to be taking cash flow out and paying yourselves, or are you going to reinvest it back into the business? Does that partner need money right away? If you're somebody who is looking at a long-term game, you're not going to be taking out the cash flow for 10 plus years. You're just going to be reinvesting and growing the portfolio, and your other partner is not good at managing money and they're going to be needing to take quarterly distributions. That's really going to kill the cash flow and your ability to really grow your rental portfolio. So those are all decisions that you have to make. And maybe you guys might come to clashes if, hey, I want to rehab it this way, or I want to buy it in this neighborhood. Maybe I don't want to refinance it right now. Those are all key decision points where if you are the only person that owns the rental portfolio, then you are the captain of the ship. However, if you bring in a partner, please note that you're going to also bring in another person that is going to be making those decisions as well. Now, there's different ways to structure the operating agreement where maybe you are going to be making the decision, but make sure that you're finding somebody who has complementary skills. I've personally bought 4 units together with an equity partner. This is a good friend of mine from my childhood. And there were multiple benefits such as pooling of resources, increased capital, and the diversification of risk. So I saw a lot of the upside, which is why I decided to partner up with said individual. So let's just say you are great at marketing and can find distressed properties from motivated sellers for 20-40 cents on the dollar. This is a huge value add for an investor who has the money and the capital, but maybe not the time to execute on the direct mail campaigns to the seller or call motivated sellers. But by teaming up, you find the deal, which is a great value, and they bring the capital, because if that person can find the deal but don't have the capital, then you can't close on any properties, right? So by teaming up with each other, you are able to take down a property with significant upside and refinance once the rehab is complete, allowing each of the partners to recoup their initial investment and time and create the value that would otherwise be unavailable had they chosen to work as separate individuals. So these are 4 ways that have really allowed me to purchase the 61 units in the span of 3 years. And as you continue to gain experience, you'll learn different ways other than these 4 that I mentioned to add more tools to your tool belt, such as seller financing, subject to, and be a little creative when you're purchasing these rentals. Especially in a time where COVID is creating a lot of uncertainties, you are just approaching every deal with a hammer and think everything is a nail. That's all you're going to be able to do. But if you bring a wrench, if you bring a screwdriver, you're bringing different types of tools to the game, then you're going to be able to do more deals. You're creating more value, and you're going to be able to put more money into your pocket. There's definitely more than one way to invest in real estate, so find a way that really works best for you to meet your goals. I gave that previous example of $400 a month in net cash flow after all expenses and debt service on that duplex. It might not feel literally, life-changing when you first get that property. However, think of what that would look like if you have 4 of them. Now it's at $1,600 a month. Maybe that's going to pay for your apartment, or maybe that's going to cover all your food and your car expenses and gas. So if you start eliminating some of those expenses, the mindset shifts, and it's going to be an exponential growth, because these small changes and building blocks will be the foundation that will eventually lead you to create thousands of dollars in passive cash flow and achieve financial freedom. I really hope that was helpful for you guys. I created this 7-step podcast series for those individuals looking to buy their first rental property but didn't know where to begin. And there is a ton of information out there, whether it be other people's podcasts, forums, webinars. So too much information, a confused mind does not take action. So I really wanted to make it easy for you step by step. Go out there and buy your first rental property. So I really encourage you to take another listen on these episodes if you need a refresher, but go ahead and take that first step. Make that first call with a broker or an agent to start learning. You don't have to buy it immediately. You got to educate yourself first, but it's really important that you go ahead and take that first step. So hopefully that was helpful for you guys. Please do me a favor and leave me a review on iTunes. It really helps me motivated and keep me going. I'll see you right back here next week for another exciting episode of the Bigger Cashflow Podcast. Thank you for listening to the Bigger Cashflow Podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.